Have you ever wondered how economists measure inflation? The answer lies in the Consumer Price Index, or CPI. This index is like a thermometer for the economy, giving us a reading on the heat of price changes. Imagine walking into a supermarket a year ago and spending $100 on groceries. Now imagine walking into the same supermarket today and spending $105. This is inflation in action. The CPI captures these price differences over time. It tells us how much more or less we're paying for a basket of goods and services. Governments use it to make critical decisions about interest rates and social programs. Businesses use it to adjust prices and wages. So, buckle up and let's unlock the secrets of CPI together. Now that we understand the what of CPI, let's unravel the how. Calculating the CPI is a complex process involving a lot of data crunching. Imagine a giant shopping basket filled with all the things an average consumer buys. This includes everything from housing and transportation to food, healthcare, and entertainment. The Bureau of Labor Statistics, BLS, carefully tracks the prices of these goods and services each month. They collect price data from thousands of retailers across the country. They then use a weighted average formula to determine the overall price change of the basket. This means that some items like housing have a greater impact on the CPI than others, like movie tickets. The CPI is then compared to a base period, usually a previous year. The difference between the two periods represents the percentage change in prices. Why should investors care about a basket of goods? Because the CPI is a powerful tool for predicting future trends and making informed investment decisions. Imagine you've invested in a bond that pays a fixed interest rate of 3%. What if inflation rises to 5%? Suddenly your real return is negative. Your money is losing purchasing power faster than it's growing. By tracking CPI data, investors can gauge inflationary pressures in the economy. This allows them to make informed decisions about asset allocation and protect their wealth from being eroded by inflation. Remember, a successful investor seeks returns that outpace inflation. Stay tuned. Understanding CPI data is like reading a map of the economic landscape. It tells us where we are, where we're going, and how to navigate potential hazards. The first thing to remember is that CPI is a lagging indicator. It tells us what has already happened to prices, not what will happen in the future. However, by analyzing CPI trends over time, we can identify patterns and make informed predictions about future inflation. For example, a steady upward trend in CPI suggests rising inflationary pressures. Conversely, a downward trend in CPI could indicate deflationary pressures. By carefully analyzing CPI data, investors can gain valuable insights into the health of the economy and make informed investment decisions. So, how do we use our newfound CPI knowledge to build an inflation-resistant portfolio? It's all about strategic diversification. Consider assets that have historically acted as inflation hedges. Real estate is a classic example. As inflation rises, so do property values and rental income. Commodities such as gold and oil also tend to perform well during inflationary periods. Look at equities. Companies with strong pricing power can often pass on rising costs to consumers. These might include companies in sectors like consumer staples or healthcare. Don't forget about bonds. Treasury inflation-protected securities, or TIPS, offer a unique advantage. The principal value of TIPS adjusts with inflation, ensuring that your investment keeps pace with rising prices. The best strategy will depend on your individual circumstances, risk tolerance, and investment goals. By understanding CPI and its impact on different asset classes, you can make informed decisions that protect your wealth.